Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hello, welcome to the College Investor Audio Show. So glad you're here today as we take a look at, all right, you've probably seen the commercials. What is a reverse mortgage and how do they work? And can I do one of those things? So if you're in a situation where you have a significant amount of home equity, you might want to access some of that equity and just turn it into cash. You have a few different options depending on how much equity you actually have, and of course your credit score. The two of the most common options for accessing the equity you have in your home are a home equity loan and a home equity loan of credit, or HELOC. But if you're 62 or older, you have another option to consider: a reverse mortgage. What's a reverse mortgage? A reverse mortgage is a HELOC alternative that is targeted towards older homeowners who often have completely paid off their mortgage. Like the name suggests, instead of making monthly payments to a lender, with a reverse mortgage, the lender makes monthly payments to you, the homeowner. In order to qualify for a reverse mortgage, all borrowers must be at least 62 or older. Reverse mortgages are loans that can be useful for some seniors who have a significant amount of equity in their home and just want to use some of that equity to supplement their monthly retirement income. When you apply for a reverse mortgage, your home serves as the collateral for the mortgage, just as with a conventional mortgage. When you move out or die, the loan becomes due, and any proceeds from the home's sale are used to pay off the reverse mortgage. Payments from a reverse mortgage are not considered taxable by the IRS. How do reverse mortgages actually work? There are three different kinds of reverse mortgages: single-purpose reverse mortgages, proprietary reverse mortgages, and home equity conversion mortgages. Home equity conversion mortgages, or HECMs, are by far the most common type of reverse mortgage. HECMs are sometimes referred to as FHA reverse mortgages because they're backed by the United States Department of Urban Development, HUD. When you get a reverse mortgage, the bank will take out a new loan on your property, minus any fees or lender charges associated with the origination of the loan. You can choose to take the proceeds from your reverse mortgage in a variety of ways. These are the most common ways to do it. 1, a lump sum. The bank actually gives you the entirety of the proceeds all at once, all up front. 2, an annuity. You can take equal monthly payments as long as at least one of the borrowers lives in the home. 3, term payments. So rather than an annuity, you can take monthly payments for a fixed term, like 10 or 20 years. Choosing term payments will likely mean your monthly payments will be higher than with an annuity. Or you can do a line of credit. That's the fourth option. Rather than taking payments, you can instead set up a line of credit where you can borrow money as needed and then just only pay interest on the amount you borrowed. Now, let's take a look at how to get a reverse mortgage. Applying for a reverse mortgage works in much the same way as applying for a conventional mortgage. You can work with a lender or mortgage broker of your choice. Just as with a conventional mortgage, it's usually a good idea to shop around and compare rates and terms from several different lenders. Keep in mind that if you want to apply for an HECM, you will need to apply through an FHA-approved lender. When you apply for a reverse mortgage, you're often required to go through counseling. The purpose of the counseling appointment is just to make sure that you understand all of the costs, responsibilities, and payment options that come with a reverse mortgage. The counselor should also make sure that you are aware of what will happen to the reverse mortgage when you die or if you move out of the home. So, all that said, is a reverse mortgage a good idea? Before talking about whether or not a reverse mortgage is actually a good idea, it's important to mention that while a reverse mortgage is an actual financial product, there are plenty of scams that look similar to reverse mortgages. Bad actors often prey on older homeowners who may not be as able to protect themselves from scams. So just make sure to be aware and vigilant for yourself and any other older homeowners in your life. If they're kicking around a reverse mortgage idea, keep your ears out and give them this information we're sharing with you today. A reverse mortgage might be right for some homeowners, and then just not the best move for other people. One thing to think about as you're considering a reverse mortgage is deciding how much money you really need to retire. That can help you decide if the additional income that comes from a reverse mortgage fits into your retirement plans. Having significant equity in your home, both you and your spouse being 62 or older, and not having any plans to move are indicators that a reverse mortgage might make sense. On the other hand, if you might move, aren't sure if you're, going to be able to keep up with maintenance, taxes, and insurance, or if your kids may want to inherit your house when you're gone, a reverse mortgage may not be the right move for you. If you want to access some of the equity in your home, but the traditional methods, including reverse mortgages, don't work for you, Unison, UNISON, is another option to access some of the equity in your home. The bottom line? A reverse mortgage is one way to access the equity in your home as long as you're 62 or older. With a reverse mortgage, the lender will provide you with access to your equity in exchange for monthly payments on the loan. You can take the proceeds from your reverse mortgage in all kinds of different ways, like we talked about earlier: lump sum, monthly payments for a fixed term, or an annuity good for as long as you live in the home. While reverse mortgages can make sense for some people, they're just not right for everybody. Make sure to talk to your financial advisor to see if it makes sense for you. And if you have more questions, you want to dive a little bit deeper, we have links and resources and all kinds of great stuff for you at thecollegeinvestor.com. Copy and paste the podcast title right into the search bar, and you'll find it. And if you have any older homeowners in your life that are thinking about reverse mortgages, which is what brought you here today to find out what they were, please feel free to share this podcast with them so they at least have a little bit of direction before making the decision. Thanks again for stopping by today, and we'll talk to you again real soon.